Alright, hey, what's up? My name is Rob. A lot of you guys probably know me as Zero, and I'm one of the Nice Trades stock admins. And I thought it would be cool if I started a weekly lesson series where I basically go over a topic or a question that you guys have, um, and I try to help you guys become better traders because here at Nice Trades, we don't only want to guide you guys, but we want to actually um, grow you guys to be sustainable, self-sustainable, profitable traders. So for this first lesson that I have prepared for you guys, I want to go over Statistical Edge, which is pretty much the foundation of becoming a profitable trader. Statistical Edge is made up of two components, the first one being risk management, and the second one being having a profitable setup, so an A setup, for example. And if we break it down further, the reason risk management is important is because one, it limits your losses, and it allows you to have a statistical edge in the long run because if we look at this graph right here, if you have a one-to-one risk reward, which basically means let's say you enter a trade with $1,000 and you make 10%, that's $100, right? So every time you take a trade, you're aiming to get that 10%. But every time you lose, you also take a 10% loss. So every time you win, you make $100, but every time you lose $100. So for this strategy, you would need a 50% win rate to break even, but anything above a 50% win rate and you would be profitable, which is okay, but ideally you want a higher reward than a risk. So let's say you go from a 1-to-1 to a 1-2, which is probably the most common. So if you have a 1-2 risk reward, which basically means every time you take a loss, you take a 10% loss, but every time you take a win, you take a, let's say, 20% win. So for this, you would need a 33% win rate. So think about that, a 33% win rate. That's it. You only have to win 3 out of 10 trades pretty much, which is pretty crazy if you think about it, because I'm pretty sure a lot of you guys trading right now probably have a higher than 33% win rate, but you might be losing money or you might be breaking even. But that's the power of risk management. Now let's take it a step further. Let's say you have a 3-to-1 win rate. Then you would only, or a 3-to-1 risk reward, sorry. Then you would only need a 25% win rate to break even. So anything above that, you would be making money. And if we keep going further, a 4-to-1, 20%, 5-to-1, 16%. If you have a 10-to-1, you only have to be winning 1 out of every 10 trades to break even. And if you have a 120, which is pretty crazy, I haven't seen anybody yet that has that crazy of a risk reward, you would only need a 5% to break even, which is pretty crazy, but it's kind of unrealistic because I haven't seen anybody with the high of a risk reward. But I guess it is possible. But anyways, I just want to highlight from this slide the importance of having risk management and a higher than 101 risk reward, because that makes it so much easier on yourself, because then you don't need to stress about winning every single trade. You literally only need a 40% win rate to be a profitable trader with a 2-to-1 risk reward. Think about that. So moving on, here's just an example that I took from the Discord. I think Ola, one of the admins, posted this, so definitely check it out. But if you guys want to pause the video and read through this, go ahead. But it's just an example of how powerful risk to reward really is. Anyways, I want to go through a strategy known as the R multiple, which is basically a way of keeping track of your risk to reward. So it's actually on a Google sheet here. So give me a second. All right, here we go. So this is a Google sheet, and I'll be sharing this with you guys so you guys can actually use this. But we're just gonna be using the example of starting capital at $1,000. But pretty much what this does, it's like an interactive sheet that lets you input like your daily P&L. That way it updates your risk in real time. So R would pretty much be what you're risking per trade. So that's your one risk, and then this would be if you're aiming for a 3R, so 3-to-1 risk reward. You could also change this to a 2R, and then this would be $100. But we just have it set up for a 3R, but you can set it up for a 2R, 4R, depending on your strategy, because everybody's strategy is going to be a little bit different. But if you can see here, so account size $1,000, your risk per trade would be $50, which is a little bit high. That's 5% for an account, but because it is a smaller account, that still only comes out to $50. But again, you can adjust this to 2% of accounts, so $20. 1% of your account, $10. It's up to you, but again, it depends on your strategy and your account size and all that. But based on $1,000 account size, we would be risking $50 per trade, and our daily max loss would be set at $100. So 2 times. So if we go red, fully stopped out of 2 trades, that would be our daily max loss, which comes out to be 10% of the account, which again is pretty high, but it is a smaller account. This just calculates your R return. So if you input, let's say you take 1 winning trade for that day, your R return would be 2.61. And then you see as you input, your profit every day, it's going to update your R and your 3R. So your risk to reward is going to change, grows. But let's say you take a daily max loss, which would be two losses. Now your account is at 1,035, but you see how you're still profitable after taking 2 losses and just 1 win. And let's say we take another loss, negative 51.75, which is our risk per trade, and then this goes down even lower. So every time we take a loss, our risk is decreasing, just like our returns would increase as our account grows. So let's say we take a win here. Now we're back in the green, $74, and our risk increases once again. So this is helpful because as you're trading, you don't have to be calculating what your risk per trade is. This does it for you. And also, as you take losses, you're sizing down, and as you take wins, you're sizing up. And this just helps you keep track of that. So it's a helpful tool. If you guys want the link to that, I'll be sharing it with you guys along with the video. But let's continue with the slides. Okay, now the second component of having statistical edge is actually having a winning, profitable strategy / setup. So you have to have a setup in order to be a profitable trader. That's common sense, but so an actual example of a winning profitable trader that I actually use pretty consistently is a previous high of day break. And this is an example of the setup. So this is actually a trade I took on Friday on AMD. And you can see how right here, this was a previous high of day. So on the 12th, this was the highest it reached that day. And then on Friday the 13th, we broke that level, and then we actually ended up having a really nice run here. So this would be our entry point once it breaks that level. And you can see definitely would have been a profitable trade if you took this. I think the contracts ended up running 100, 150%, if not 200% at the very peak. I probably sold it somewhere around this area, but it did end up running to 200% just for one contract. Of course, it was 0 DT options, but you can see just how profitable this strategy can be, or the setup can be, and that's why it's classified as an A setup, which just basically means it's a top tier setup. And now let's go and see what some of the criteria for this particular setup are. So the first thing I look for is the chart has to be in an uptrend. So basically anything above the 90 EMA on the 4-hour, I would classify that as being in an uptrend or starting an uptrend, as it is here, a reversal. So you see how AMD has been on a very nice uptrend for the past couple weeks, and then it took some a pullback, which was a healthy, needed pullback after running from 80s to 120, back down to 110s. So had a nice pullback, and then once it started getting back over the 90 EMA, you can start seeing it make attempts at a reversal. So that caught my attention, and that's one of the criteria for this setup. And then the second criteria is elevated RVOL, which is relative volume. So you can see here very clearly had elevated volume compared to the previous day, and even if you look at the 4-hour previous couple of days. And then the third criteria is I like to take this setup in the morning because that's when we have the most volatility and momentum in stocks. So anywhere between 6:30 to 8 a.m. Pacific, that's around the time I want to be taking this setup particular, because that's where I found it's the most profitable, the most consistent, and just the best time to be taking it. So you can see this trade happened just around 7 is when it broke out, and then it lasted up until like 7:40ish, we'll call it. Let's say it lasted till 8. That's still between our time, because we're looking for the time of breakout for it to be in between 6:30 and 8, and that was around 7. So clearly fits in our criteria for this setup. So that's just an example of a setup and some of the criteria. There's a little bit more criteria that I also key for this setup, but I'm not going to share everything. These are the main criteria I look for, and it's just I'm showing you guys this to show you guys an example of what a setup should look like, and some of the criteria you should have included with that setup. Because the reason why it's important to have a setup is because that way, if you have a clear criteria, it's easy to that way it's easy to replicate the strategy. That way, every time you take a trade, the criteria you're looking for. You're not just guessing every time you enter a trade, like, oh, I feel like I want to enter this trade. No, you know exactly why you're entering the trade, and you have set criteria for it. And it's also important because it allows you to keep statistics on it. So this is just a very small sample size. It's only 10 trades. I have a much larger sample size for my own personal setups, but I just want to give you guys an example. And this is something you should start tracking. So for this setup, previous high day break, my last 10 trades, let's say, I had 8 wins and 2 losses, which is an 80% win rate. And if we go back to the risk reward again, if you have a 3-to-1 R, you only need a 33% win rate, I think it is. So you can see we're way above that. P&L, I'm not going to include that, but if you wanted to, you can include your P&L here. Average percent return, which we'll go over that in a second, but our average percent winner is 46%, and our average percent loser is 8%, because if you look back, it's very easy to know when you're wrong on this setup. If it breaks it and then it starts coming back down, you sell immediately, because you don't want to see that. You want this to break and like pretty instantly start running. So this setup is pretty good in that right away if you're right or wrong. If we get a break and then it starts consolidating or it starts dropping, you want to get out as soon as possible. Of course, you want to give it some room, but generally speaking, it's pretty easy to tell when you're right or wrong on this setup. And then our winners are pretty big, because you can see, look at this run up. So like I said, the trade ended up going 200%. So if you ended up taking the full trade, that's 200%. Let's say you take an average 10% loss on this trade. That's a 20-to-1 risk reward. So yeah, that's a pretty insane setup. But anyways, going back to this, so our average percentage return, calculating these two combined, would be 35%. So our risk reward is pretty much a 4-to-1, and our win percentage is 80%. So this is a very profitable setup, and that's why it's considered an A setup. But that's pretty much it. I think this is the last slide I had. Yeah. So going back to the first slide. So yeah, that's basically Statistical Edge. That's what I wanted to go over in this lesson, and hopefully you guys now better understand why it's important to have Statistical Edge. And what Statistical Edge pretty much means is you've proven to yourself that your setup has a good winning percentage, or a very good what's it called, risk to reward. So our risk is 8% and our reward is 46% on average. So that's what you're looking for. And it doesn't have to be this previous high of day break. You can have your own particular setup, but what's important is that you have a set criteria and that you have proven to yourself that it's a profitable setup. And that's pretty much all it takes. That combined with having the proper risk management, and you're pretty much a profitable trader. Obviously, there's a lot more that goes into it, like emotional aspects, which we'll cover in future lessons. But for the very foundation, that's pretty much what's essential to being a profitable trader, having a profitable setup and having the proper risk management to go along with it. But yeah, I hope you guys took something from this lesson. Hope you guys enjoyed it. And if you guys have any topics, questions, or anything you guys want me to cover in future lessons, let me know in the Discord. Just at me, and then just put a video lesson idea, video lesson question, and then I'll try to go over that in the future lessons. But yeah, thank you guys so much for watching. Hope you guys, like I said, learned something from it.